In a system of capitalism, one of the things that we find is that companies and countries and markets that are at the top often continue to consume a lot of market share. It almost acts as a winner take all market. So, United States being at the top, still experiencing growth when a lot of other major nations are slightly pulling back from a growth trajectory. What tends to happen is capital then starts flowing more into the United States from other countries. So just by us being at the top, still having better growth than everyone else, that attracts more capital and then thus adds to things like GDP, also adds to inflation. But it does add into the general overall wealth of the nation because capital not only grows from within, but it actually pulls in capital from markets outside of itself.
You are going to get left behind in this economy because your finances are not well positioned. My name is Kyrie. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
Welcome back to Well Positioned. This is your host, Kyrie Graves. One of the things we want to do on this channel is to help us, that is you and I, be as well positioned in financial markets as we possibly can. And that takes some legwork. That's going to include us understanding where we are in the economic cycle and the business cycle. That's going to take understanding how things like interest rates and earnings and debt spending and liquidity and all those things are affecting how markets are moving. So that kind of gives an idea of like a lot of the different things that we cover. And then on top of that, various, geopolitical news and things like that also do have some impacts on markets. And when we say being well positioned, we're talking about folks that are positioned in retirement accounts like 401ks, IRAs, things like that. General trading accounts and folks who may be making short-term moves as opposed to positioning our portfolios for the long term. So it's best to have a great understanding of the backdrop that we are in, and then we can then capitalize on whatever time frame we are maneuvering money on. So with that in mind, on this episode, we're going to go over just a couple of things in the markets. We are getting close to the end of March in 2024. We recently had a Fed FOMC meeting. My biggest takeaway of that meeting was the Fed is still posturing markets and is still explaining to markets that they want to still do rate cuts as the year progresses. They want to see inflation, particularly headline inflation, continue to fall meaningfully enough to give them confidence to cut rates, because from what I understand, the Fed is afraid to cut rates too soon, which could ignite a whole new round of inflation, and then that can be very impactful on consumers and people like ourselves who are spending money. If we keep seeing higher and higher prices, that will affect the overall economic environment that we are in, because we may not want to spend as much money on certain things, and those things like that. Inflation can trigger a recession. So that is one of the things that the Fed is mindful of, and that one of the things that we have to be mindful of. So just as a general market participant and as a general citizen and consumer of the United States, we all want to see inflation to continue to come down. That is going to be positive for pretty much everyone across the board. Having, headline prices like food and energy and producer goods and services and things like that We want to see them, well, I'll take it back. I don't think we'll see these prices come down, but we want to stop seeing them go up. That is the main thing. So, with that in mind, let's actually look at growth and inflation. That'll be one of the things that we're looking at in terms of reasons to be bullish, I guess you can say, or continue to have conviction to the upside in these markets. We're also going to look at government spending in the Federal Reserve's balance sheet and seeing how capital flows are going in and out of the market and affecting overall, S&P 500 prices. And on top of that, we're going to look at possible shifts in capital flows. So remember, we were talking about how Federal Reserve spending and government spending do have an effect on, whether directly or indirectly, on overall market flows, and where capital is being invested and flown to. So we want to see how capital is moving, not even just from outside sources, but investors and traders in the market. How are they now maneuvering investment capital through these markets? So we're going to go over those couple things. So without further ado, let's get into the charts, and I'm going to share my screen and go over a few more things. All right, so one of the things we're looking at here, I have some notes here that I like to keep handy. So we're going to look at growth and inflation. That's something we're going to take a look at here. And one of the best ways I do that here is by going to tradingeconomics.com. That is a resource that kind of measures, it's a little bit of a lagging information, but it's helpful to just realize where we are, currently, and where we're coming from, right? So as we're digesting future economic data, we at least have a frame of reference of where we are coming from. So when we see GDP is up, 3% or whatever the headline may be, we know that it's coming off of, a base understanding. So speaking of GDP, let's look at this GDP indicator. This is just general GDP across all major nations. And as obviously we see United States at the very top. And we're seeing just general growth. This is measured in billions of dollars. And we're seeing overall growth in terms of GDP. Certain places we are seeing some declines, like in Japan, we are seeing a bit of a decline. In the Eurozone, we're seeing a bit of decline. China still a slight peak up. Germany, we're seeing a decline. India, we're seeing an increase. United Kingdom, we're seeing a slight decline. France, slight decline. Russia, we're seeing a positive increase. Canada, we're seeing a positive increase. Italy, decline. Brazil, positive increase. And any further down we go here has less of an impact, I would say, in how we are positioned here in the United States. Not that we don't care about them, but we want to focus on what truly matters to our bottom line. So in terms of GDP, the overall moral of the story is we are growing in the United States still. And if we're looking at full year GDP and we're going into the United States here, we're seeing in percentage terms, we went from a 1.9% GDP to a 2.5% GDP growth. And that was for, I believe they're calculating this for the year 2023 and then 2022 respectively. So we are in 2024 now. We're waiting for the next. And that's something we like to do here is see what's coming up next. What is our next GDP print? So we're looking at GDP print growth for the United States. And we're seeing here that on Thursday, March 28th, we get a new GDP, different ways that economic data is presenting GDP. So this is GDP growth rate quarter over quarter. This is GDP sales quarter over quarter. This is real consumer spending quarter over quarter. So these different things are going to help us get a better understanding of how growth is coming into play. One thing we take away from that list of GDP countries is that we see not only is United States at the top, but we are still growing and growing by a meaningful number. So just keep that in mind. And let me stop sharing for a second. This is something I want to highlight. Just keep that in mind is that, in a system of capitalism, one of the things that we find is that companies and countries and markets that are at the top often continue to consume a lot of market share. And basically, it almost acts as a winner take all market. So, United States being at the top, still experiencing growth when a lot of other major nations are slightly pulling back from a growth trajectory. What tends to happen is capital then starts flowing more into the United States from other countries. So just by us being at the top, still having better growth than everyone else, that attracts more capital and then thus adds to things like GDP. It also adds to inflation, but it does add into the general overall wealth of the nation because capital not only grows from within, but it actually pulls in capital um, from markets outside of itself. So that's something to be very mindful of if anyone's wondering why, the United States is continuing to outperform year over year across other, other nations. That is a huge factor.
Now let's move back into consumer prices. Or so, like I said, growth and inflation are one of the reasons that drives higher asset prices.
When you have growth and inflation, that means you have an increase of prices, which will increase of consumer prices will often give an increase of corporate prices in terms of your earnings. So that's why we often see earnings are just growing year over year. A lot of that's driven by inflation, but a lot of times and sometimes it is not just driven by inflation. It could be driven by other things such as just increased productivity, within the company. So, and obviously growth is going to be a positive aspect of higher prices across the board. So growth and inflation are two things we are looking at the moment. So we've seen growth, we understand GDP, we understand the magnetic effect that the United States has to pull in capital. What we're seeing here is increase in month over month inflation here in the United States. We want to see that, or not that we want to see, but we are seeing just general increase in month over month inflation. So two factors, we got growth increasing, inflation increasing, typically bullish for markets. So let's move on to government spending and the Federal Reserve balance sheet. So to look at government spending, we're going to go to usaspending.gov is a great website because we just want to generally see how capital is being spent on the physical side of our country. So we just want to see pretty much before and after COVID is the time period that I'm most interested in. Okay, yeah, this is such a helpful tool because it's going to give us just a general idea of government spending by our Congress and our executive branch signing into law these expenses. And you can you can go and look at the categories of exactly how money is being spent. And we'll quickly do that before we get out of this particular resource. But just keep in mind what we're looking at here. Leading up to, so obviously in Q3 2022 was when the major economic spending bill was passed to provide aid to the nation in terms of the effects of COVID. But leading up to that, we were pretty much south of $1 trillion per quarter. And that's pretty important to note because yes, getting close to 1 trillion per quarter is a lot. We at least had some type of restraint leading up to COVID, and pretty much after COVID, we have surpassed all of those. We have surpassed that $1 trillion mark by quite a bit, quite a margin on a lot of fronts. So going into recent quarters, we see that uh, in Q2, we haven't even started Q2 yet, and already we are 800 trillion. So obviously, there's some budgetary items there that have increased. And I actually just checked this website a few days ago, and that number was not that high. But in Q1, it looks like they kind of have determined in Q1 we are north of 1 trillion by about $45 billion. And it seems as though the government spending has not stopped since COVID, and it's only really increased and doesn't have any signs of slowing down. We're going to go to the Federal Reserve website, and this is something that is pretty important to kind of just take a look at every now and again.
what we see is that, same deal in April of 2020. We see a huge jump, during the pandemic in the Federal Reserve's balance sheet, and it continued to slowly creep and climb, leading up to pretty much kind of peaked out in 2020, early 2020. So we had 2 years of capital flowing into the markets, and then that we'll see on the S&P charts. We can overlay that with the huge run in asset prices over that time period. But then we start to see that the Fed not only raising interest rates after that time frame, but also lowering its balance sheet. But what we saw on the government spending side is while the Federal Reserve was decreasing their balance sheet and raising interest rates, the liquidity that the private sector relied on was being supplemented by government spending. So we kind of see that liquidity, whether directly or indirectly, still found a way to flow into the economy, which then flows into capital markets. And that's just something very important to note. So there hasn't been much change in the path of the Federal Reserve's balance sheet, but they have been lowering it pretty substantially. They've gotten south of $8 trillion, which is great. And the balance sheet basically consists of financial assets, pretty much on the credit side. You're talking bonds, you're talking mortgage-backed securities, and you're talking various corporate credit bonds. So one of the things that I was noting and kind of looking out for post Federal Reserve speech. So the Federal Reserve spoke this past Wednesday. I believe that was on the 20th. And if the markets reacted positively and felt reassured that the Federal Reserve was going to eventually cut rates at some point in the future, or this year, I should say, then I was really looking to see the Russell 2000 perform well to the upside. And we saw that. We saw that exactly. And that was a good thing. I'm glad we saw that because that let me know and confirmed to me that I'm on the right side of understanding these markets. I understand that the Russell 2000 is made up of a lot of smaller companies within the United States. And these smaller companies tend to hold a lot of debt. And when a company holds a lot of debt, higher interest rates impact their profit margins. Understanding that, companies with more debt are more impacted in terms of profit margins to interest rates. When we hear the Federal Reserve start to speak on lowering interest rates and that they're still continuing and hoping to do that, and are positioning themselves to do that once they see a meaningful decline in inflation, that is positive for the Russell 2000. So when we looked at the S&P 500 and we saw that on the Federal Reserve, the FOMC day, they had a 1% move to the upside, which is a big move for the spiders, for the SPY S&P 500, in general. But what we see here is that the Russell 2000 on that same day had an increase of all the way up to the highs of almost 2.6%, closing up 2.2%. So almost double the reaction positively than we saw in the S&P 500. And that kind of gave me a little bit of an indicator to say, hey, maybe investors are ready to start changing their tune on the Russell 2000, because as we see here in the Russell 2000, prior to Fed Day, prior to that day that the Federal Reserve spoke, the Russell 2000 was only up 3.4%, right? And if we look at the S&P 500 during that same time, year to date, we see that the S&P 500 was up almost 10%. So that goes to show how investors were positioning themselves since the beginning of the year. They were favoring the bigger company names, in the S&P 500, the big tech names. They were taking a lot of the capital flows and the market share. That was pretty obvious. But the question arises going forward, do we start to see markets act a little bit more favorably to the smaller names? Some of the names that are more sensitive to the interest rate cuts. So we see that the SPY still overall responded positively, but the Russell by no means should be discounted as a possible avenue or channel where capital may start flowing into now that we have some reassurance from the Federal Reserve. Let's go over a couple of things I'm looking forward to over the next few days, next week.
One of the things I want to see is how markets respond to the IWM and to the Russell, and even sectors such as like the gold markets and the metals markets and the mining markets. Um, if we start to see capital flowing into them, that's going to give us a greater sign that not only is the bull market still intact and here to stay for a little bit longer, it actually just structurally gives the market a better foundation when you have some of the lower capitalized names actually participating in the upward trajectory of markets. That just gives a better foundation for markets, and it allows money to be and profits to be taken from the top and given to the bottom. So if we start to see that, that will allow me to have greater conviction. One of the things I did within my longer term portfolios is I have started allocating some capital to small cap and mid cap names within my like 401k and things like that. I think it's time that we start to deploy a little bit of money into those names and allow them to start, performing or maybe even outperforming going forward. But we are mindful of, possible slowdown at some point this year. But if the Federal Reserve can cut interest rates soon enough, that may allow for what they're calling a soft landing, meaning as we were in a hiking interest rate cycle, that cycle has now ended. In their words, we want to make sure that the economy is not going to fall hard as a result of the raising of interest rates. If we can get an interest rate cut sooner than later, that will keep demand, general consumer demand and producer demand from falling too far too fast, and then still allow to be a steady trajectory going higher and higher. So that's one of the things we're looking for going forward. I'll be back with another video not too long from now, maybe the next couple of days. I appreciate you guys so much for tuning in, and hopefully you learned a few things and now have a few things to keep an eye on as we move forward. Continue to follow this channel because we will compound on a lot of the knowledge that we're kind of compiling here and try to get a better overall thesis of how we want to be well positioned in these markets. So if you're somebody that is looking to get started on this journey of being well positioned, I suggest you pick up my book, One Small Tweak. One Small Tweak will give you an idea of how to participate in markets on the growth and fixed income side. Those are very important items to have when you're talking about the foundation of wealth. And then we also talk about how to protect those items properly and protect that portfolio properly. So get yourself a balanced portfolio with the right assets that are positioned in the right way. And from there, you can then start compounding on your knowledge the way we're doing here. If you want to get into short-term trading, day trading, swing trading, things like that, have your foundation set first. That is so important. I can't stress that enough. Once I implemented my foundation, I felt way more confident to, do things like hedging and short-term trading and things like that. But I don't think I have anything else more for you on this video. I hope everyone has a great day, and we'll be back again.